Hello and welcome to Business Career College's Continuing Education course series. My name is Colin Johnson and I'll be taking you through the course Know Your Customer Regulations and Benefits today. I'm Director of Operations with Business Career College and I'll start off today with an outline of the Know Your Customer Regulations and Benefits course. It's a three-part course starting with identifying what knowing your customer is. It's also frequently known as KYC. In that, we'll look at the three-step process of knowing your customer. Once we identify what knowing your customer is, we'll move on to some reasons to follow KYC, both from a regulatory perspective, looking specifically at 4 regulators that in the financial services industry you may encounter as a regulator of yourself as a professional. Once we've looked at those regulators, we'll look at some non-regulatory reasons that you would want to follow the Know Your Customer requirements that are out there. We'll finish off the course in a 2-part section that looks at a case study in action, followed by some best practices that you can use to enhance your practice in your profession. I hope that you see a great deal of benefit from this in learning that KYC is more than a regulatory requirement. So let's start out by developing a common understanding of what knowing your customer is. So knowing your customer does exist in various regulatory environments, but generally speaking, it's an overarching term that's in place around the sets of regulations or guidelines in various industries about being able to reduce fraud and increase the quality of advice that you provide to your customers. Now, sometimes you will hear it shortened to KYC. You may also hear the term knowing your client. Knowing your customer does tend to be a more common term currently, but all 3 of those mean the same thing. Now, as I said, the KYC requirements exist in various regulatory environments, so they will be slightly different or sometimes significantly different depending on which regulator we're dealing with at the time. But generally speaking, there are 3 parts to knowing your customer. The first is getting to know the current situation of your customer, which is often looked at in a snapshot. So this will be a variety of things, including knowing what your customer's financial situation is, what their personal situation is in terms of family, whether they have a wife or a child, and so on. The second part is focused on what your customer's plans are for the future. So depending what kind of professional you are, if you're working in the life insurance industry, you may want to look at things like health issues that are going on from the snapshot that you looked at, as well as marital status and whether they have children. If you're working in an investment environment, you'll be more concerned with when they're planning to use the money that they're investing. The third part of the KYC, generally speaking, is looking at the amount of risk that your customer is comfortable with. Different customers will have different levels of comfort with change, so whether that's change in the value of their product or generally change that may happen over the term of their life. When you're looking at their risk tolerance and their tolerance for change, you're considering all of these things. Let's take a closer look at the client snapshot part of knowing your customer. This is a critical part of the Know Your Customer process where you're actually going to get to know a lot of the personal and financial information about your customer. Now, a lot of this may seem like data collection where you may be filling in a form depending on the industry that you're in, but this is as much about building a relationship with your customer as it is about collecting that information. There's 2 types of information that we're going to be looking at specifically. One is the personal information of your customer, and the second is information about their financial situation. So on a personal information side, you may be asking some basic questions like the age of your customer, whether they have a spouse or a partner, whether they have any children, but you also will be going more in depth to look at things like the age of their partner, the age of their children, whether they have other relatives that they're supporting in their home. You really want a complete picture of your customer's personal situation. Now, the second side of this is getting a thorough understanding of their financial situation. Now, most times we do this through a set of questions that are going to establish what your customer's net worth is. So net worth, all that really means is comparing what your customer owns with what your customer owes. So you're going to look at their assets, or what they own, and you're going to subtract from that their liabilities, or what they owe to other people. So when you're looking at your customer's assets, you may be looking at things like whether they own their home, whether they have a car, any savings that they might have, and any investments that they have. You will also look at insurance policies that they hold that have value. When you look at the liability side, or what they owe, you're going to be looking at some of the more obvious things that will come out of what they own. Like if they own a home, you'll want to ask if they have a mortgage on that home. If they own a car, you'll want to ask if that car is financed. Beyond that, you want to look at personal loans and credit cards, as well as loans that they may have to other people or to businesses. When you look at that, the third critical point on the financial snapshot is to look at any financial liabilities that they've co-signed on. So if they're a parent of an adult child, they may have co-signed for a loan for that child. All of this is part of getting that complete picture, and as you're getting this complete picture, you're developing a richer relationship with your client to help give them the best advice going forward. Now that we've taken a look at the client snapshot, let's move into what we've called future plans. So just like in the client snapshot, future plans has a side based around the personal information of your client, as well as a side based around the financial information of your client. So we want to focus both on their personal future plans and their financial future plans. So starting with their personal future plans, you'll want to look at things that may have financial implications but may not be directly financial. So is your customer looking to get married or have children in the future? Those definitely have financial implications, but your customers may not see them as a financial decision. Are they looking at going back to school or retiring? Again, they have financial implications, but they also have non-financial implications. So you'll use this information that you get around their personal future plans to generally look at what kind of products would be most appropriate for your client. Now, the second half is their future financial plans. These have some more finite details that you're going to look at, or more definite details. So you want to look at things like changes in their liabilities and assets, because you've just gone through a net worth statement. So if they have a regular mortgage payment that they make, but their mortgage is going to be paid off in the near future, that's definitely a financial future plan of theirs. Or if they want to pay more to pay off their mortgage more quickly. When you look at changes in their assets or what they own, are they looking to make major purchases in the future, or are they looking to invest in investments or purchase life insurance policies in the future that will be assets? Again, when you look at future plans, if you've already had the conversation that they're planning to get married in the near future, that also is going to change their liabilities and their assets, because you'll now have two customers with assets that may be shared and liabilities that may be shared. You'll also want to look at changes to their earnings. So if, as we mentioned before, they're planning to retire, it's important to note that their income is probably going to change quite dramatically. If they're going to return to school to study for a new career, their income may temporarily be decreasing, their savings may temporarily be decreasing, but their potential income afterwards may be increasing. So future plans can be anywhere from a shorter term future plan in the 1 to 5 year range to a longer future plan. And then the last part that we generally look at when we're looking at future plans is who they support or their dependents. So this could be more obvious changes like a choice to have a child who will be a dependent for many years for them. But it may also be changes like a child becoming an adult and moving away from home where they're not supporting that dependent anymore. Another consideration that you may want to look at is if they have aging parents that they're going to be taking care of. With an aging population in Canada, this is a more common thing that we are seeing among some communities where clients are supporting their aging parents, and that creates an extra level of support that they need to provide. The third part of the Know Your Customer process that we're going to look at in this course is your customer's comfort with change and risk. So when we look at this, again, we can look at it from a financial and from a non-financial perspective, or from a financial and a personal perspective with each customer. So from a financial perspective, generally what we're going to say is we're looking at risk or risk tolerance with your customer and from your client. So we would look at how much change in the value of an asset or the value of a liability that your customer is comfortable with. So when we look at an investment and we look at suitability, we look at how much your customer would be comfortable seeing that investment change going up or down in value in a shorter term and then in a longer term. When we look at a liability, we may be looking at something like a mortgage, where the type of mortgage that you would recommend to a customer may change, again, based on what they're comfortable with in seeing their interest rate on their mortgage change, or if they're comfortable with that at all. We also can look at this from a non-financial perspective. And I think, again, this is just as important as the financial perspective, but it's often overlooked in the Know Your Customer process. So looking at it from a non-financial perspective, what we may look at is, generally speaking, how comfortable your customer is with change that is going to happen in their life. So if you have a customer that has a child that's going to be going to university in 5 to 10 years, and you're talking with that customer about that, and they're very nervous about that child leaving home and that child being able to support themselves, you may be able to recommend products that will make that change easier for them. If you're looking at retirement, for a different example, again, you may be able to provide solutions to your customer that will make them more comfortable with the idea of retiring. Now, every customer is going to be a little bit different in terms of what level of change or what level of risk they're comfortable with in the financial situation. And that is going to be something that's very personal for them and based on their experience and also what sort of time frame they're looking at. That being said, you can't always assume that your customer's level of risk isn't going to change. As a customer ages, that may change, but even if we look at a different type of situation, it may be different. So if a customer has a retirement fund, the level of risk that they're comfortable with of change in that retirement fund may be very different than the level of change they're comfortable with on their mortgage rate, which impacts them more immediately. Let's take a moment to review the Know Your Customer process before we move on to the next section of this course. Knowing your customer is an ongoing process, so it's a set of conversations that you're going to have many times with a customer, and as such, it can be used to build a strong relationship with that customer so that you can give them the best solutions that are customized for them and the best advice that you know how to give them. Generally speaking, we talked about it including 3 parts. So there's the client snapshot, where you get to know what their current situation is, a review of their future plans, where you get to understand what they want to do going forward, and then a discussion around their comfort with change or risk, which may involve a specific tool depending on your regulator, or a specific questionnaire depending on the organization that you work with. It is very important to keep in mind that knowing your customer is much more than following a set of rules that you have to follow for regulatory reasons. That is important to follow them for regulatory reasons, but it's as much about giving the best service to your customer that you can.